Okay, so you're here and you want to know, like, what's happening in the economy. Right. I get it. You want to get up to speed quickly without getting lost in all the details.
Yeah.
So that's what we're doing today. We're taking a deep dive into a really important update, the Reserve Bank of India's Monetary Policy Review.
Great.
It came out on April 9th, 2025, so just a couple days ago.
Yeah, so this is your fast track to understanding, like, what the RBI is doing and why it matters.
Exactly.
And to give you a really well-rounded view, we're not just looking at the RBI's official statement.
Right.
We're also bringing in the expert analysis from HDFC Asset Management Company.
Okay, yeah, because they're a big player.
Yeah, so it's kind of like getting two perspectives for the price of one right.
Yeah.
You get to see what the central bank is thinking, but also how the market is like interpreting those thoughts and what they're expecting to happen next.
That's right.
So you get the full picture.
So let's break it down. Okay. Well, what's the goal here? Our mission today is to cut through all the noise and really zoom in on like the most important takeaways.
Absolutely.
We're talking about interest rates, what the RBI thinks about economic growth, and where they see inflation headed.
Right.
By the end of this, you'll have a much clearer sense of where the economy is going and what it might mean for you, for your wallet, for your investments.
Exactly. So let's dive straight into the biggest news, the most important decision from the RBI.
Right. The big headline, the Monetary Policy Committee, or MPC, they made a pretty big decision. They actually lowered the policy repo rate by 25 basis points, bringing it down to 6%. Now, some of our listeners might be thinking, what exactly is the policy repo rate? Well, it's basically the rate at which commercial banks borrow money.
Short-term funds.
Yeah, short-term funds from the RBI.
From the central bank.
Think of it as the central bank's like main tool for controlling borrowing costs across the entire economy.
Yeah, it's a big lever that they can pull to make borrowing cheaper or more expensive, and that impacts everything else.
Yeah, right, exactly. So this cut in the repo rate signals that the RBI is trying to encourage more borrowing and spending to stimulate the economy.
Right, and what's maybe even more interesting than the rate cut itself is the change in the RBI stance.
Right.
On monetary policy, they've shifted from a neutral stance to an accommodative stance.
Yeah, and I think it's important to kind of explain what does that even mean? Like an accommodative stance.
Yeah, accommodative basically means that the central bank is saying, hey, we're really focused on supporting economic growth right now.
Okay.
And we're willing to keep interest rates low or even cut them further.
Oh, okay. So they're basically saying we're not going to raise rates anytime soon.
Probably not.
Yeah.
No, they're much more worried about growth than about inflation at this point.
Interesting. Okay, so lower interest rates for the foreseeable future.
Yeah, that seems to be the message.
Okay, and this is actually a pretty big shift because for a while the RBI was in this neutral stance, like waiting to see which way the economy would go.
Right, exactly. They were sitting on the fence.
Right, but now it seems like they're more confident that they need to support growth.
Yeah, and the RBI governor even said that future actions under this accommodative stance would likely be either holding rates steady or cutting them even further.
Wow. Okay, so they're really leaning in that direction.
Yeah.
Towards lower interest rates.
It's pretty clear.
Okay, so how did the markets react to this announcement?
Yeah, well, you know, the financial markets, they always react to this kind of news. And
right, they're always listening.
Yeah, and this time they saw this announcement and the tone of this statement overall as being very dovish.
Dovish.
Yeah, dovish means...
Calling it dove?
Yeah, kind of, yeah. It basically means that the central bank is in favor of easing monetary policy.
Okay.
Which typically means lowering interest rates. So they saw this as a very dovish statement. And what happened was government security yields, often called GSEC yields, rallied by 5 to 7 basis points.
Okay, so yields went up.
Well, no, actually, yields went down.
Yeah.
Because remember, bond prices and yields move in opposite directions.
Oh, right.
So when yields rally, it means bond prices went up.
Okay.
And that means investors are expecting lower interest rates in the future.
Right, because they're buying up those bonds.
Exactly.
Okay, so the markets are really betting on lower rates.
Yeah, and some analysts are even saying that they now expect even deeper rate cuts than they did before.
Wow.
Like at least 50 basis points more in this cycle.
Really? So they think the RBI might cut rates by another 0.5 percentage point.
Yeah, potentially. It's a pretty strong signal that they think the economy needs more help and that interest rates are headed even lower.
Wow. Okay, that's a lot to digest. But It's really interesting to see how the market is interpreting all this.
It is, and it shows you how closely they watch every move the RBI makes.
Right, every word, every signal.
Exactly.
Okay, so let's shift gears a little bit and talk about economic growth.
Okay.
Because it's clear that the RBI is keeping a very close eye on what's happening globally.
Oh, absolutely. The global landscape is always a big factor in the decisions.
And they specifically mentioned these increased global uncertainties arising from tariff measures.
Right, which are basically taxes on imported goods.
Yeah, and the RBI is worried about how these trade disputes could hurt global economic activity and potentially lead to higher inflation worldwide.
Right, because if other countries are growing more slowly, that could mean less demand for Indian exports.
Right.
And if global inflation is rising, that could eventually spill over into India.
Right, so it's all connected.
It is. Everything's interconnected in the global economy.
So even though we're talking about India, we have to keep an eye on what's happening in the rest of the world.
Absolutely.
Okay, so those are the global headwinds.
Yes.
But what about the domestic picture? What's happening within India?
Well, there are actually some positive signs on the domestic front.
Okay, good.
RBI pointed out that rural demand is pretty strong.
Oh, that's good to hear.
Yeah, and that's really important for India because such a large portion of the population lives in rural areas.
Right.
And this strong demand is being driven by expectations of a good rabi crop.
The winter harvest?
Yeah, exactly. Things like wheat and barley, and also the expectation of a normal monsoon season.
Right, which is really important for the next agricultural season.
Absolutely. So a good performance from agriculture is a huge boost for the Indian economy.
Right, and it trickles down to so many other sectors?
Exactly.
Okay, so rural demand is looking good. What about urban consumption?
Well, the RBI also observed a recent pickup in urban consumption.
Okay, so people in the cities are spending more.
Yeah, and they think this trend could continue because of ongoing fiscal support from the government.
Like government spending programs.
Yeah, exactly, things like that. And also increased government capital expenditure.
Right.
Which is basically investment in infrastructure projects.
Okay.
And they also see potential for a revival in private sector investment.
So things are looking up in the cities, too.
It seems like it's...
Yeah. Okay, so we've got these positive factors within India, but the potential negative impact from global trade disruptions is still a big worry for the RBI.
Yes, that's right. It's this balancing act.
Right. They're trying to weigh the good against the bad.
Exactly.
Okay, so taking all of this into account,
Yeah.
the domestic factors and the global factors,
Yes.
the RBI has actually revised down its forecast for India's GDP growth for the fiscal year 2026.
Right.
By a small amount, 20 basis points to 6.5%.
Yeah, so they basically nudged their forecast down a little bit.
Right, but it's still positive growth.
Oh, yeah. Definitely still a sign of a healthy economy.
Okay, and they also gave us a breakdown of their expectations for each quarter of the fiscal year.
Yeah, they did.
So for FY26, they're expecting growth of 6.5% in the first quarter.
Okay.
Followed by 6.7% in the second quarter, then 6.6% in the third quarter, and then it moderates a little bit to 6.3% in the final quarter.
Okay, so a bit of a slowdown as the year goes on.
Right, but still overall positive growth.
Yes.
Okay, so that's the growth outlook. Let's move on to inflation now.
Well,
okay.
Because inflation is always a big concern for central banks.
Absolutely. It's one of their main mandates is to keep inflation under control.
Right, and the RBI pointed out that the inflation figures for January and February, as measured by the Consumer Price Index, or CPI,
right,
which tracks the average change in prices of goods and services that households consume.
Yeah, basically how much more expensive things are getting for the average person.
Exactly. So those CPI numbers for January and February were actually lower than the RBI had expected.
Oh, interesting.
Yeah, and this was mainly because of a decrease in food prices.
Okay.
Particularly vegetables.
That makes sense. Vegetables can be very volatile.
Right, they can fluctuate a lot.
Yeah.
But interestingly, they did notice a slight increase in what's called core inflation.
Okay.
Which is inflation excluding volatile items like food and fuel.
So basically it's a measure of underlying inflation.
Yeah, like the more persistent price pressures.
Right.
And this increase in core inflation was mainly driven by rising gold prices. Okay, gold is often seen as a safe haven asset. So when people are worried about the economy, they tend to buy more gold.
Right, which can push up the price.
Yeah.
Okay, so that's interesting. But what I found really notable was the RBI's assessment of the future path of food inflation.
Yeah, what are they saying about that?
Well, they actually said that the outlook has turned decisively positive.
Wow, so they're pretty optimistic.
Yeah, they are, and this optimism is mainly based on those favorable Rabi crop prospects we talked about earlier, along with record production levels for key staples like wheat and pulses.
Okay, so a bumper crop?
Yeah, basically. And on top of that, strong Kharif arrivals.
That's the autumn harvest.
Right. Crops like rice and cotton are also coming in strong.
Okay, so all of that is contributing to this positive outlook for food inflation.
Right, and the RBI seems pretty confident that we're on track for a durable softening in food inflation.
That's great news because food prices are a big part of people's budgets.
Absolutely, especially for lower-income households. So if food prices are coming down, that could provide some real relief.
It could, yeah.
Okay, so it's not just food prices that are pointing to lower inflation.
Right.
The RBI also highlighted a decline in inflation expectations.
Oh, interesting.
Yeah. So both consumers and businesses are expecting inflation to be lower in the future.
And that's important because expectations can actually influence behavior.
Right. If people expect prices to go up, they might start buying more now before prices rise even further.
Exactly.
Which can actually create more inflation.
Right. It can become a self-fulfilling prophecy.
So the fact that inflation expectations are coming down is a good sign.
It is. It suggests that people are more confident that inflation is under control.
Right.
And on top of that, there's the recent fall in global crude oil prices.
Right.
Which is also helping to keep inflation in check.
Yeah, because oil is such a key input for so many goods and services.
Exactly. So when oil prices fall, it can have a ripple effect throughout the economy.
Right. So all of these factors together, the lower food prices, the declining inflation expectations, the lower oil prices,
yes,
have led the RBI to revise down its average CPI inflation forecast for the entire fiscal year 2026.
Okay.
They've lowered it by 20 basis points to an average of 4%.
Wow, so they've really lowered their inflation forecast.
Yeah, they have.
And to break it down even further, the RBI now expects CPI inflation to average 3.6% in the first quarter of FY26.
Okay.
Rising slightly to 3.9% in the second quarter. Then moderating a bit to 3.8% in the third quarter.
Okay.
And then ticking up to 4.4% in the final quarter.
Okay, so it's a bit of a roller coaster ride.
Yeah. But the key takeaway is that they expect inflation to remain below their medium-term target of 4% until the third quarter of FY26.
That's significant.
It gives them more room to maneuver.
Right, because if inflation is under control, they can focus more on supporting growth.
Exactly.
Okay, so we've talked about interest rates, we've talked about growth, we've talked about inflation.
Yeah.
Now, let's turn our attention to what all of this means for the fixed income market.
Okay, the bond market.
Yeah, exactly. So for our listeners who might not be familiar with the fixed income market, this is the market for debt instruments like bonds.
Yeah, so basically when you buy a bond, you're lending money to the issuer.
Right. Could be a government, could be a company.
Exactly. And in return, they pay you interest over time.
Right. And then you get your principal back at maturity.
Exactly.
So this market is very sensitive to interest rate movements.
Oh, absolutely. Because as interest rates rise, the value of existing bonds tends to fall.
Right. And vice versa.
Yes. So when interest rates fall, bond prices tend to rise.
Okay. So the analysis we have from HDFC Asset Management Company.
Yes.
They offer some really valuable insights into the fixed income market.
They do. They have a lot of expertise in this area.
Right. And their overall perspective on the Indian fixed income market for the medium term, let's say over the next few years, is quite favorable.
Okay. So they're bullish on bonds.
Yeah, they are. And this positive view is based on a lot of the factors we've already discussed.
Right.
Notably, the fact that headline CPI inflation is close to the RBI's target and the overall positive outlook for inflation.
Yeah, so inflation is under control.
Right. Which is good for bonds.
It is.
They also point to the relatively subdued domestic economic growth.
Right.
And the contained momentum of core inflation as supporting factors for the fixed income market.
So basically, when growth isn't overheating and underlying inflation is in check, it creates a more stable environment for bond investments.
Right, exactly.
And that can lead to potentially higher returns.
Yeah.
They also highlight the comfortable levels of liquidity in the financial system.
Now, what does that mean, liquidity?
Yeah, so liquidity basically refers to the availability of cash and easily convertible assets within the financial system.
So it's like how much money is sloshing around.
Yeah, exactly. And when there's ample liquidity, it helps in the transmission of interest rate cuts, meaning banks are more likely to pass on those lower rates to borrowers.
Okay.
And it also generally supports bond prices.
Right. So more liquidity is good for the bond market.
Yeah, it is.
Okay. What else are they saying?
Well, they also view the external sector.
So India's interactions with the global economy as potentially stable.
Yeah, thanks to continued growth in services exports and the lower oil prices.
Okay, so that's good news.
Yeah, it is. Although they do caution that we need to keep an eye on the volatility of the Indian rupee.
Right, because if the rupee weakens too much, that could make imports more expensive and lead to imported inflation.
Exactly.
Okay, and one more thing they highlighted was the government's commitment to fiscal consolidation.
Right.
Which is basically their efforts to manage the budget deficit and reduce the overall debt burden.
Yeah, so basically trying to get the government's finances in order.
Right, and this is seen as a positive for the bond market because when the government borrows less, it can put downward pressure on bond yields, which makes existing bonds more attractive.
Exactly.
Okay, and finally, the analysis suggests that the anticipated slowdown in global economic growth, due to those trade tensions we talked about earlier, particularly involving the U.S., could actually further support this favorable outlook for Indian fixed income?
Interesting. So basically they're saying a weaker global economy could actually be good for Indian bonds.
Yeah, because it could lead to lower global interest rates.
Right.
Which would make Indian bonds relatively more attractive to international investors.
Exactly. So there's this potential flight to safety.
Right. Investors looking for a safe haven.
Yeah. And Indian bonds could benefit from that.
Okay, so that's a lot of information. But the bottom line is that HDFC is pretty optimistic about the Indian fixed income market.
Yeah, they are.
But they do highlight some risks.
Oh, absolutely. No outlook is without risks.
Right. So what are some of the things that could derail this positive scenario?
Well, one of the main risks they identify is a further escalation of the global trade war.
Right, if things really heat up between the U.S. and other countries.
Yeah, that could lead to higher prices for goods across the board.
Right.
Potentially reigniting inflation.
Which would be bad for bonds.
Yeah, because inflation erodes the value of fixed income investments.
Right.
Another big risk, specifically for India, is the performance of the monsoon.
Right, if the monsoon is weak or uneven.
Yeah, it could lead to a sharp increase in food prices.
Which we talked about earlier.
Yeah, and that would have a knock-on effect on overall inflation.
And finally, a significant depreciation of the Indian rupee could also pose a risk to the bond market.
Right, because a weaker rupee makes imports more expensive.
Right.
Leading to imported inflation.
And it could also make Indian bonds less attractive to foreign investors.
Exactly, because they would be worried about losing money on the currency exchange.
Right, so those are some of the key risks to watch out for.
Yeah, but even with those risks, the overall sentiment is still positive.
Right.
It's just important to be aware of the potential downsides.
Absolutely. Okay, so for our listeners who are thinking about how to invest in this environment, HDFC has some specific recommendations.
They do.
Based on their assessment, they suggest considering investments in medium duration categories within fixed income.
Okay.
Specifically funds with a Macaulay duration of up to 5 years.
Now, Macaulay duration might sound complicated.
Yeah, it is a bit technical.
But basically, it's a measure of a bond's interest rate sensitivity.
Right. So a higher duration means the bond is more sensitive to changes in interest rates.
Exactly.
So a duration of up to 5 years suggests a moderate level of sensitivity.
Yeah, you're not taking on too much interest rate risk.
Right.
But you still have the potential for some capital appreciation if rates fall.
Okay, and within this medium duration space, they specifically recommend corporate bond-focused funds.
Okay.
They say these funds offer attractive yield spreads compared to government securities.
Right, meaning you get a higher return for the same level of risk.
And they also expect further interest rate cuts, which could boost the value of these bonds.
Okay, so that's for investors with a medium-term time horizon.
Right.
What about investors with a longer time horizon?
Well, for those who are comfortable with potentially higher levels of risk, they suggest increasing their allocation to longer duration funds.
Right, because those funds are more sensitive to interest rate movements.
Right.
And could potentially offer higher returns if rates continue to fall.
Okay. And they even gave us a breakdown of suggested fund categories based on different investment timeframes.
Oh, that's helpful.
It is so for an investment horizon of 2 years and beyond, they suggest looking at long duration funds and hybrid income plus arbitrage fund of funds.
Okay.
For a time frame of 12 months to 2 years, they recommend considering corporate bond funds.
Okay.
And for shorter horizons of up to 12 months, they point to money market funds,
Right.
ultra short duration funds, and liquid funds.
Okay, so a whole range of options depending on your time horizon and your risk tolerance.
Right, and it's important to remember that these are just general recommendations. Any investment decisions should always be made in consultation with a financial advisor.
Right.
And based on your own individual risk tolerance and financial goals.
Always good to get professional advice before making any big investment decisions.
Absolutely. Okay, so let's wrap things up here.
Okay.
What are the key takeaways for our listeners?
Yeah, let's summarize what we've learned.
Well, the RBI has cut interest rates and signaled that they're willing to ease further.
Right.
Driven by concerns about the global economic outlook, even as parts of the domestic economy are showing resilience.
Yeah, it's a mixed bag.
Right. They've slightly lowered their growth forecasts, but they're much more optimistic about bringing inflation under control.
Yeah, they seem pretty confident about inflation.
And this overall backdrop creates a generally positive environment for the Indian fixed income market in the medium term.
Yeah, bonds are looking pretty good.
But we have to keep in mind those key risks.
Right, those global trade tensions, the monsoon, and the stability of the rupee.
Those are the wild cards.
Yeah, they are.
So we'll have to keep an eye on those.
Absolutely.
So I think this gives our listeners a really good understanding of what's going on.
It does, yeah.
The key decisions and the thinking behind the RBI's latest policy review.
Right, and how a major player in the market is interpreting these developments.
Exactly, and the potential implications for investors.
Yeah, it all ties together.
It does. It really highlights how interconnected everything is.
It does, yeah.
Okay, so here's something I want our listeners to think about.
Okay.
Given the RBI's confidence in this decisive improvement in the inflation outlook, what specific factors do you think will be the most critical in ensuring that this downward trend in inflation continues?
That's a great question.
And what unforeseen challenges might emerge that could potentially derail this optimistic view?
Yeah, what could throw a wrench in the works?
Right, because there are always surprises in the economy.
Always.
So it's something to think about.
It is. Yeah, it's a fascinating question.
As we navigate this ever-changing economic landscape, thanks for taking this deep dive with us.
It's been a pleasure.
We'll see you next time.
See you then.